Hi, good morning. We're gonna get started. I see some folks still popping on, but we'll catch up real quick. Thank you for joining us this morning. I'm Jane DeSalta, Vice President of the Southern New Jersey Development Council. First, we hope that you, your family, and your work family have been safe and healthy throughout this health crisis. Here at the Development Council, we continue to advance our mission to promote economic growth in South Jersey through our efforts in hands-on economic development and advocacy, as well as access to information that supports business retention and expansion. That includes today's webinar, a product of our Economic Development Committee, with two special guests who will discuss the financial ramifications of the pandemic and potential roads to an economic recovery. After each speaker's remarks, we plan to have approximately 10 minutes for audience questions and answers. I ask that you submit your questions for David and then for Joel through the WebEx Q&A feature. We'll be recording the webinar and we will share a link to the replay. Before I introduce our moderator, a quick thank you to our partners who helped support today's webinar and have joined us. Christy Howe, President of the Burlington County Chamber of Commerce, Janet Garrity with the Gloucester County Chamber of Commerce, and Lauren Moore with the Atlantic County Economic Alliance. There were also several of our members, municipal members, who invited their local businesses. And they've joined us this morning as well. Deptford Township Mayor Medani, Washington Township Mayor Gattinelli, and Berlin Borough Mayor Miller. We welcome them and their guests. Now I'd like to introduce our title sponsor, Denise Monahan, Group Vice President of M&T Bank, a multi-state, community-focused bank that provides banking, investment, insurance, and mortgage financial services to over 3.5 million consumer, business, and government clients. With 30-plus years of banking as the Greater Philadelphia Southern New Jersey Group Vice President, Denise oversees relationship and portfolio managers in South Jersey and Philadelphia for M&T Bank. Denise's responsibilities include coordinating existing and new client acquisition, strategic initiatives, sponsorships, and talent development throughout M&T's commercial bank segment. And with that, I am pleased to turn the program over to Denise.
Thank you, Jane, and good morning, everyone. First, on behalf of all of my colleagues here at M&T Bank, it's truly great to support the Southern New Jersey Development Council, and more importantly, such a timely and important topic and a great conversation that we're going to have this morning. Especially as we sit here today, it is the last day of the month. It is the last day of the second quarter, and I think we can all sit back and say, oh my goodness, what a start to 2020 we have had. And as a banker, and I'm sure there's several bankers in the crowd today, we've all been quite busy with facilitating the PPP loan program. We're now starting to facilitate the forgiveness program, evaluate the Main Street lending program, and most importantly, stay connected to our clients so that we can continue to service them properly and navigate these economic cycles that we are going through. And there's no better way than to bring timely topics that are insights, ideas on real issues that we face every day in which you're looking for some perspective. And there's no two better folks to do that than David Kotok and Joel Naroff. And so it's truly an honor this morning to be here with you, David, and with Joel. We've got a lot to cover, and I'm going to get right into the agenda with my introduction of you, David. I think it's fair to say, first and foremost, you are a true South Jerseyan. David co-founded Cumberland Advisors in 1973 in his hometown of Vineland, New Jersey, and he has been the chief investment officer ever since. Cumberland Advisors is an asset manager with approximately $3 billion of fixed income, as well as equity accounts that services clients both domestically and internationally. They service individuals, institutions, retirement plans, and government entities. Mr. Kotok is not only known to us in Southern New Jersey, but very well known to the financial markets, in which he has appeared in the New York Times, the Wall Street Journal, and Barron's, and other publications where he's a frequent guest, as well on Bloomberg TV and other radio and media outlets. He has served as the commissioner on the Delaware River Port Authority and on the Treasury transition teams for New Jersey Governors Kaine and Whitman. He has also served as a board member of the Southern New Jersey Development Council, as well as the New Jersey Economic Development Authority. David is a seasoned professional with great perspective and with that, it is my honor to turn the floor over to you, David, and we look forward to the comments that you're going to share on the markets, the economic recovery, and how our audience can be best positioned for what lies ahead. David?
Denise, thank you for very kind introductory remarks. And I appreciate the opportunity to virtually visit my old neighborhood, notwithstanding the fact that I'm actually in Sarasota at the moment. I thank Jane for all of her preparatory help, and Ben, and I specifically am pleased to be able to be joined with Joel Neroff, a friend of, I would say, many decades. So it's a pleasure this morning. Let me see if I can help from a perspective. Cumberland Advisors, by the way, we're up to 3.7 billion, and our clients in direct accounts are all over the United States, 40 some states, and several countries as far away as New Zealand. We talk to them daily, so we get perspectives from the entire world. Let me spend 2 minutes on this virus with those perspectives. We see, of course, a worldwide surge, and we know that a mutation, which some may have read about, has made this particularly virulent and vicious. The mutation strengthens the spike on the coronavirus, which attaches to the cell. And it does so through a complicated factor, but the fact is it makes it very transmissible. So here in Sarasota, we have a city council that has passed the mask ordinance. We'll fine people if they don't wear a mask. The first fine is $250. The next one's $500. In other places, different rules, but there's a lot of controversy. I will tell you, in my own lifestyle, I wear a mask every time I go out my front door. I use an iodine composition spray for additional defense. I wear gloves in every supermarket. I do all of the hand washing and all of the personal hygiene before and after, and I view the front door of my living quarters as a front line in a war zone. Anybody who has a comorbidity of profile of any type, I'm one of them, this virus can kill you. And it's as simple as that. So those who say we need to deal with it in some other way are fooling themselves. That leads me to 17 minutes to talk about economics and financial markets and the outlook, 10 minutes of Q&A, and then let me make room for my friend Joel. So here's where we are. We think of it in the following way. The economy was in a 10-year recovery. Interest rates were up, then down, then up, and then being reduced. Growth was continuous with some volatility, and the unemployment rate in the United States was down to around 4%, depending on how you estimate it. And that's where we were in January or February. The virus at that point in time was not pandemic, it was epidemic. It was in China, and it was spreading around the world, and some reactions from some governments were strong and others were a mixed bag and poor. I would rate the United States as poor. We knew about it as early as December. We were in the middle of a trade war negotiation with China. The trade war economic negotiation took precedence over medical preparedness. Then the CDC had a failed testing because it was contaminated. No one admits responsibility, and we now have a medical disaster in the United States. We went to pandemic stage. No one wanted to believe the pandemic. So behaviors had to change only after pandemic was proven. We still have some behaviors, like a congressman from Florida who won't wear a mask in the House of Representatives. He says, I'll put a mask on when I get sick. Idiot, really. And he comes from my now state of Florida. I don't have a way to go vote against him. I would if I could. I'm in a different district. What does it mean for the economics? Let's get to it. We went from an unemployment rate of 4%, round numbers, to an unemployment rate of 20%, and we did it in 6 weeks. That is remarkable. In the Great Depression, it took 4 years. We have never had a shock like this fast, this big in the United States. The policy response from the Federal Reserve has been extraordinary. You heard Denise outline several programs. When you total up the programs, they are in the trillions. What the Fed did is immediately begin to implement programs that it knew how they would work from the financial crisis 10 years ago, and then it's adding and added, both are taking place, a whole bunch of new ones. There are several that haven't even rolled out yet. That's the Federal Reserve response. So interest rates go down to near zero, out comes credit facilities, and they are remarkable and unprecedented in size. At the same time, fiscal response was huge. Federal government agreed to borrow trillions and spend it on programs. You heard some comments about them. Before we went online, I was talking with Denise about the PPP program, which her bank implemented for its customers, and we talked about the statistics. That's one bank. Think of the entire United States and those who took advantage of the program. So fiscal stimulus, very large. Monetary stimulus, very large, both without precedents in history. Economic shock, enormous. And now we had a market, stock market, went from, say, 3,300 on the S&P 500 index to 2,100 in a straight line. It was a waterfall. It panicked investors and it shocked policymakers. And I think part of the reason the policymakers move so fast is because of that shock. Whatever it took, they did it. We have seen a recovery in the stock market. Right now, it's at 3060 on the S&P 500 index. We have seen a recovery in the bond market, which fell apart. And we have seen the bond market now split into two categories. One, think of it as some investment grade, could be BBB, doesn't have to be AAA, prior to the crisis. That's one category of debt. In the other categories of debt, those that are private sector debt, those that are below investment grade in the junk category debt, those that are in various types of derivative forms like CLOs, there's another problem. They are not receiving and will not receive help from the policymakers. They get it indirectly, but not directly. So we now have two categories of operating businesses in the United States. One that gets direct help, one that doesn't. The ones that don't get direct help have to pay a premium price to get it indirectly. Let me explain quickly. Verizon was a company which was on the Federal Reserve 794 issue list. It's available to the public on the New York Fed website. And Verizon is a company whose bonds are able to be purchased by the Fed in this new corporate bond buying program, which is rolling out right now. Sprint is not on that list. What does that mean? It means Verizon gets subsidy not directly from the Fed, but because it's backstopped in its debt issuance by the Fed, the interest rates Verizon will pay are relatively lower than they would otherwise be. At the same time, Sprint, not on that list, has the opposite effect and would pay an interest rate a little higher than it would otherwise be. In the investment community, what we do is track the spread between the two. So we are able to assess the benefit to one company and the detriment to another. We don't like it that the Fed is picking winners and losers. It's a dangerous thing as a policy matter, but they're doing it. So it's not about what could, should, it's about what is. Let's get to the economic outlook. There's a thing called survivor bias. We don't talk about it much, but it's there. What does it say? If I'm a company, a business, I've exercised all the disciplines, I've watched my capital, and I survive this shock, I'm going to come out of this shock lean, mean, profitable, productively enhanced. I will have learned and I will have survived. The guy across the street who didn't survive isn't there anymore. That is true in the national indicators. That is true in the local indicators. It's true in southern New Jersey, where Cumberland still has a small office in Vineland. And it's true everywhere in the world. So you have to think of the survivor bias in a context. Let me give you a specific example. If you look at the S&P 500 index, which is a living, recalculated index, Macy's was in it in January. Macy's isn't in it now. The S&P committee is redesigning the composition, and it is looking for the survivors. That's part of what it does. So the metrics we use, like the Standard & Poor's 500 index, are changing. They are reflecting things. And the capturing of them in data, employment, in GDP, in sales, in other measures, and there are hundreds of them that Joel and I look at all the time, are changing. That means the old tests and old measures that we may have used in the past when things were calm are highly suspect now. One has to be very careful about conclusions. I see that I have about 5 minutes left. Is that right, Denise?
That is correct.
Okay.
Doing well. You're doing well.
Well, it's my first time. Thank you. So let's take this 5 minutes and talk about what lies ahead. We will get to treatments. We already see some improving treatment with the use of remdesivir, which helps reduce fatalities for severely sick, and dexamethasone, which helps reduce inflammation for people who get sick. They have to get sick, they have to be tested, they have to have confirmation, they have to have some breathing difficulty, because otherwise they'll be at home and won't get medical treatment and they'll tough it out. There's a lot of cases like that. But those who cross the line have some treatment. We also saw massive political blunder in treatment. The hydroxychloroquine was a mess. It was a politicized failure and probably did two things: cause some people to die from cardiac failure, that's a side effect, and raise the price of those who need the drug for lupus or other purposes fivefold, and developed a black market. One of my colleagues in my firm who takes hydroxychloroquine for his own treatment saw the price of an infusion go from $35, the published price, to $170 in a black market. That's what happens when politics intervenes in a pandemic, and it happened to the United States in a huge way. We have to surmount it. Let's get to the other side. We're looking across a valley. What does the valley look like? It's 6 months so far. We've got another 6 months or a year or 18 months or something, and we will have treatments. There are 140 worldwide present phased in vaccine and treatment protocols at work today. Some of them are showing success. We will have testing. We'll do it the hard way. You can always trust Americans to do it the hard way rather than the easy way. Churchill alluded to something like that. But we're going to do it. So we'll have the testing. We'll have the antibody testing. We'll get treatments. The treatments will save lives. Fewer people will be hospitalized. And we will roll out the herd immunity the hard way. But we're going to do it. On the other side of the valley, when some number like 60 or 70% of a population reach protection, business can resume not normal because we've all been punished and are scared, but a new normal. Here's what that looks like to us. The new normal, we think, will be about 90% of the GDP of the United States. So if we think of ourselves as a run rate of about 22 trillion nationwide, we're going to be at 18 or 19. On the other side of the valley, let's call that 2 years from now. The unemployment rate by that time, we think, will be down to 10 or 11 or 12 or 14% or 9%. Remember, those are numbers which were at the worst of the financial crisis in 2008 and 9. The economy of the United States will be growing, in our view, very robustly. Growth rates will then be climbing rapidly. And the companies and businesses which have survived, remember the survivor bias, will be enormously advantaged in that growth. So we see the V down, we see a sort of a square root sign, the V back, we're in it right now, but it doesn't go back to where it was before this all started in February. And then we start a gradual program. There's something called an output gap. It's technical. I don't want to spend a lot of time with it, but it's a version of an estimate of how big the damage is cumulatively. Ben Bernanke and Janet Yellen have jointly published on that. Their estimate is 16 trillion, which is a monster output gap. That means if they're close to right, and it makes no difference whether it's 14, 15, 16, 17, 18. Forget the economists trying to get to the decimal point. If you have an output gap like that, and you have a survivor bias in businesses and enterprises, and you have massive additional liquidity credit support, unlike ever in the past, and you have massive fiscal policy in place, you get a roaring recovery. Now, we will have paid for that recovery with probably 250,000 dead Americans. And we will have paid for that recovery with probably 200 million sick and recovered Americans. But that's where the United States is likely to be, in our view, on the other side of this valley. So we're in the middle of a bridge. We don't know how far to the other side. We can see ways to get to it. We have great uncertainties. So all forecasts have huge error terms. There's a margin for error on all sides. And we have a change in political regime that we cannot forecast today. It's a long way between now and November. And we have to deal with the policies that are coming. At the same time, we have a very threatening geopolitical picture around the world, and we're in a trade war with the second largest economy in the world, China. I'll stop there, Denise, if it's all right.
Great.
I hope I was able to cover the water in a little bit, and let's take the 10 minutes for questions.
David, thank you so much for your comments. You covered a lot in 17 minutes, and I took some notes, but in 17 minutes, you touched on a lot of themes. You touched on first the great divide, people that think we have a pandemic and others that are choosing perhaps to ignore it, and what the impacts of that are. You talked about a survivor bias. You talked about what lies ahead and the criteria that's changing as we evaluate the S&P. You talked about a new normal. You got into a little bit of the alphabet soup of a V or a W. And so if you're an investor, an individual that's sitting here today listening to this presentation, what is an investor today to do if they are sitting on cash? Do they stay on the sidelines? Do they put their money to work? What advice do you have for the everyday investor of how they should be navigating this market on a personal level?
I suggest first, investors take a deep breath. 2, if they like wine, make it a nice wine and enjoy it. With a good meal, it's always a good idea. I would now do the rest the following way. And here's what we do at Cumberland, and what I do in conversations like this is not say what somebody else should do. What I do is say, here's what we are doing. Remember, we manage 2,700 portfolios, and we see sectors in the following place which are bargains. First, in the bond sector, the tax-free municipal bond is yielding way above the taxable treasury. It's a bargain. If you're in a state like New Jersey, where you have high state taxes, and depending on the outcome of the election, you may have changes in the tax code, which will even make tax-free bonds more attractive, they're a bargain. If you think that the state of New Jersey is going to run out of money in default, don't buy it. But if you are willing to accept the fact that the New Jersey Turnpike, a franchise which is a monopoly, is not going to go out of business, then do buy it. Tax-free bonds are cheap. They yield more than taxable securities in the high-grade sector and very much more in the middle investment grade sector. We have whole strategies. If anybody wants to know about them, they can email me and I'll be happy to connect them. Stocks. If you're in the stock market, hold some cash reserve. Our current cash reserves range in accounts between 10 and 15%. Why? We just don't know how this plays out. The rest is deployed, and there you have to be more careful. In our stock portfolios, we are very much overweight the healthcare sector. We have been. It's been a great investment place. There's a reason. The United States had an 18% of GDP devoted to the entire healthcare sector pre-virus. Post-virus, it'll be over 20. We will be the worldwide leader in healthcare where we can partner with others in the world. And if the trade war doesn't get in the way, taking us, for example, out of the World Health Organization was a lunatic policy decision in the middle of December. I do not understand it, and no one in the profession does either. But the interfaces of companies and scientists and medical people worldwide continued. They ignored the politics, and that's a good thing. They will save lots of lives because they did so. So, healthcare sector, defense. We are overweight the defense sector in the U.S. stock market. I wish it were otherwise, but look at the world and make that judgment. And we are overweight ESG, water, wind, solar, huge overweight. We're probably 5 times the weight in the Standard & Poor's 500 index. Why? Because if there's ever a compelling case to be made for it, it's now. And we're seeing the event. In Las Vegas, Gemini is rolling out right now as we speak, 200,000 households that will be powered by solar in Nevada. Think of it, 200,000 in a solar farm that'll cost $1 billion to implement will be at work this year. In the UK, there is now a solar battery. Batteries have been a problem. How does it work? It collects the energy from the sun when the sun shines. It routes it to a compressor. It compresses air. Big, by the way, it's a big battery. When the sun doesn't shine, it releases the air, which is liquefied, and that drives a turbine, which generates electric power. I would expect to see that all over the place. I even hope it makes it to Sarasota, Florida, and Vineland, New Jersey. So the idea is there's massive in ESG. I believe you need to own some, and there are ways to do it in the investment climate. What to avoid? Watch out for the socialization risks. I wouldn't own a cruise ship company. Some of them will be bankrupt within a year or two. That is our forecast. I hope it isn't true, but it sure looks like it. Be very careful. Think of the world as the new world to come. Use all your tools to try to get to it and invest accordingly. And keep some cash because you're liable to be wrong on some of those decisions. I hope that helped.
No, that was excellent. Thank you very much, David. Jane, do we have questions on the line?
Yeah, yes, we do. Question is, what is your outlook on the municipal bond market in the intermediate and long terms, given the strain on state and local income streams currently? Do you see some municipals more than others?
Yeah, we do. We have several people who work on municipal credit in our firm. We have our own scoring and rating system of municipals in addition to the rating agencies. And there are a number of techniques that are used to assess munis besides what you see in a rating from Moody's or Standard & Poor's or Kroll's or Fitch. There are super attractive munis right now. Super. They are so relatively cheap. I have, in my 50 years in this business, never seen them this cheap. And the analysis must be deep to understand them. In the junk section, I wouldn't touch it. There's danger. Where there's a franchise, like the New Jersey Turnpike, I picked the New Jersey Turnpike because everybody on this call knows it. The New Jersey Turnpike is a monopoly. What's the worst thing that happens? It raises the tolls 50 cents or $1 to get from Wilmington to Lincoln Tunnel. It collects it because you have no other way to get there efficiently. All those cars are not going to be replaced, and trucks, by the way, are not going to be replaced by drones in the next 30 years. So the municipal bond of an essential service revenue structure, like the New Jersey Turnpike, is desirable, and it pays you more than the taxable piece. So it's tax-free. We have a number of clients around the world that come to us to buy state and local government debt because they want the US dollar income flow, and they don't pay any taxes. They think Americans are crazy in a market priced where the tax-free high grade is higher in yield than the taxable treasury. So that's what's going on in munis. I feel what's important is there are 90,526, last time I checked at Bloomberg, separate issuers of tax-free bonds. And those issuers, about 50,000 of them, will get some liquidity assistance from the Federal Reserve's program. It will help them have market function. The Fed is not going to bail out the unfunded pension liability of Illinois or Connecticut or New Jersey or Kentucky. But what it is going to do is facilitate market function and pricing. It is already doing so, and it's working. So check the credits 16 times, do the detailed research work. Munis are cheap.
Great. Thank you for that, David. So Jane, if you don't mind, we'll move now to Joel, and then if we have time at the end, we can get more questions. And I'm sure we can all email David if we have even more questions. So, but thank you again, David. Now it's my pleasure to introduce Joel Naroff. Joel and I have known each other over 30 years. So Joel, great to see you and to be doing this program here together today. Joel is the president and founder of Naroff Economics, a strategic economic consulting firm where he advises companies from a wide range of industries on the risks and opportunities that economic developments may have on an organization's operating environment. He is the guy that we need next to us each day as we navigate these times. In addition to working with firms across the country, Mr. Naroff consults with banks on asset liability, economic growth, and credit risk issues. Joel is often quoted in the national press, including Business Week, the Wall Street Journal, New York Times, Financial Times, and Newsweek. He appears on CNBC, Fox Business, Bloomberg, CBS Evening News, and when we get closer to home, he does blogs for the Philadelphia Inquirer and other business commentary on KYW News Radio and Philadelphia media outlets. Joel is a member of the board of directors of the Economy League of Greater Philadelphia. He teaches at ABA Stonier Graduate School of Banking and the Pennsylvania Bankers Advanced School of Banking. Joel is the past chair of the American Banker Association and past president of the Philadelphia Council of Business Economics. There is no one better to give us a local view and perspective on the economy in this operating environment. Joel, welcome. We look forward to your comments.
Denise, thanks a lot. I appreciate being on this, and it's always great being with David. As he said, we go back a couple of decades at least. We've been friends and have worked together, and he always does a great job there. and I follow his advice, that's for certain. What I'd like to do is do a few things here in the relatively short period of time that I have available. Give me a second. I'm just trying to get my timer going so that I don't go too far over. Like any good economist, I'm kind of a wind-up doll. I'll fill up all the time that's available and go over it. So, but what I like to do here is, begin with a couple of quick comments about, the outlook as far as the economy is concerned, and more the national economy, because the national economy will drive the local economy. And I'm not going to get that into great detail. I think David did a really great job of doing the analysis, but there's just a couple of issues that I want to discuss. And then I want to talk more down to what you've asked me to discuss is business planning and what to look for as you're looking out to the future. And that would be more in the relatively short to medium term, but as well as the second point into the longer term, because there are changes that are here or are coming that will be with us that will really restructure the way we have to do business, and we're already having to do that. So let me just start with the national economy very, very quickly. First of all, if you're looking for my outlook on whether it's a V, a U, or a square root sign, or a swoosh, or whatever it may be, economists try and come up with the best thing so that you get your name associated with it. I wrote a piece in the April 12th Inquirer. I do a monthly business column for the Inquirer. And I talked about having a big V, little U recovery. And that's basically what David said. Initially, we had the downturn and we have the upturn. And when you start at a very low level of economic activity, all the economic numbers look fantastic. But my advice is don't worry about what happened in the second quarter. Well, you got to worry because that tells you how bad things got. Don't look at the third quarter and say, oh, things are great, because it's going to be a really, really big number. Just as the second quarter's number is going to be incredibly weak, probably the largest decline in history. We may get the largest increase in history in the third quarter. The point you have to start thinking about is where do we go from here once we have the down and then the up. And that's where I think David put it the best. It's all about the virus. And doing an economic forecast without having a forecast of the virus is extraordinarily risky. And honestly, I'm not a virologist or a geneticist or anything like that. I can only read the stuff, but I do have some concerns. And one of the concerns I have is that, if you look at what's happening in other parts of the country that have reopened too soon, in my mind, I agree with David, and made foolhardy decisions that we don't have to do certain kinds of things, what you see is a resurgence. In this area, as I see things reopening, as I walk past, restaurants and I see people congregating, as I don't see any masks almost anywhere. And right now, I've been hiding out in my place in Margate for the last few months because it was nice and quiet when I got here in March. Right now, I'm thinking of going back to Pennsylvania, where it's a lot quieter because the shore has started booming, and nobody is acting as if there's a problem out here. And this is New Jersey, where there's been significant problems. So I think the first thing you have to understand is the virus is going to return here. The question is not whether it returns, the question is how badly it returns. Hopefully, we're not going to be looking at Florida or Texas or Arizona or California, but that's an issue. But the issue there is it also tells me that in these states, we're not going to be able to open up as rapidly and as strongly as we can. And as David said, there's going to be survivors and there are going to be those that don't survive. And if you're talking 10 or 20% below where we were, that just tells me the potential for growth. Starting at a 10% lower GDP is going to be significantly lower going forward than it was in the fourth quarter of last year, the end of last year, or even in February. So when I look at growth potential, once you get past this, I think you have to start thinking that growth is going to be relatively, problematic. And it's going to be problematic because of the way the virus is going to continue to operate. David didn't talk about it, but I'm starting to read about the concept of the virus moving from being a pandemic to being endemic. That is more like some other viruses that are always around, which means we're going to have to start considering where we go from here on a long-term basis. And David's point about healthcare and moving from 18 to 20%, I think 20% is probably the bottom. I think healthcare is going to be with us for quite a while, and we're going to be spending, large amounts of it, because I think this virus, which is so, dangerous, is going to be with us for an extended period of time. So we have to keep that in mind. And what that says is you're living in a virus-imposed kind of economy, and you have to look at the different factors that are driving economic activity going forward. And what I'm suggesting is that you have to start looking at the idea of risks to growth compared to where we were before we got into this situation. And I call this looking at the microeconomies, not the general economy, not the macro economy, but within the economy, where's going to be the winners, where's going to be the losers, who are going to be the survivors and not the survivors. I think David put it in one way, I put it in the microeconomy kind of ways. And you can look at the fact that there are changes in place that are going to be with us, and going to be with us not just now, but in the extended period of time. So one of the classic examples, and I think the real issue, is what happens to downtowns. Okay, they're slowly getting better, but they're not getting better very, very quickly because of the high density kind of situations. So, what happens to restaurants? What happens to restaurants in the respect that, I do a lot of work with the restaurant industry. I work with a company that's one of the bigger data providers to the chain restaurants. And we've been trying to figure out how many restaurants will survive this. And lots of different estimates are out there. My estimate is that we could lose 25 to 30% of the restaurants. And other estimates are up to 50% or even more. I think that's too high, but it's not out of the question, even with the PPP and other government support. But the point is not just you lose restaurants, but you get into what are the economies that the restaurants support. It's the idea of the kind of labor supply that goes into it, the less skilled kind of labor that's going to lose those opportunities. You look at the services, all the companies that supply into the restaurant industry. We see that all the time. The idea of the food services, the provisions of food, both fresh and non-fresh. You look unfrozen. You look at the issue of suppliers of cleaning supplies, of dishes, and everything else that goes into the industry. What happens to those industries? When you're talking about your particular area, you're talking about your customers, you're talking about where there's going to be growth and not growth. It's not just the restaurant industry. It's the industries and the suppliers and the companies that the restaurant industry buys from. And therefore, they're going to be affected as well. This is going to be smaller, and it's going to take a long time for them to come back. The education sector. I mean, we're in South Jersey. We've got some colleges and universities. How are they going to be structured in the short term and the long term? Are we going to have residential situations or not? Are we going to be looking at reopening? Are we going to be looking at remote kind of learning? And you think about that, the kinds of economies that having students on campus compared to students not on campus, that the on-campus students support in terms of the food services, the outside businesses that they frequent, what happens to all of those? What happens to housing in terms of their living close by rather than living at home or someplace else? There are so many of those microeconomies supported by the educational system, but it's not just the colleges. What about the situation with schools? What's going to happen to them? How do they start breaking down in terms of in-person education versus remote education? We don't know, but we know in the short term, that's going to be a very, very difficult thing to get back to where we are. And we're likely to see that change. What does this mean in terms, all of this mean in terms of commercial real estate as an example? You've got a situation where in terms of commercial real estate, do businesses really need the space that we've had? We're finding lots and lots of businesses make the comment that what they're dealing with right now is an industry, in terms of commercial real estate, that simply doesn't need the space that they had prior to the virus hitting. So if you're looking at something like that, and you don't need the space that you had to have before the virus hits, you're looking at a situation where some people never come back into the offices. Some people come back at on a part-time basis. But how long does it take to even get large numbers of people back? I mean, take a look at Houston, which is having a real surge in cases. Some of the large companies tried to bring their people back, and they're now backing off of it because they just don't know how to handle it. So are we going to be changing? And the issue there, very much so, is the whole idea that the Philadelphia region, especially the center city of Philadelphia, which is acting as a major growth pole for the economy in this region, was growing as rapidly as it has because of what I call the re-centralization of both businesses and households. On the business side, an awful lot of companies were looking at the downtown area as the desirable place to be. Now that may not be as desirable. And think about all of the microeconomies that an office building or the downtown sector in Philadelphia or in Camden or even the smaller cities and towns support. What they support is not just restaurants, but they support all of the real estate that's out there. They support all of the services out there. And they provide a desirable place for people to live. There's a synergy between and a relationship between downtown living and downtown working that was moving in the favor of downtowns. I don't mean just the big cities, but even in the smaller cities. You look around, how many of the smaller cities and towns were able to move and were able to expand because of the movement back into these areas in terms of apartments, because of the re-centralization. You can call it gentrification. I call it re-centralization only because gentrification now has a bad, rep to it. But we have a change, and that's going to tremendously affect the usage of commercial real estate and retail real estate, because it's going to change the location of where businesses are, and that's going to change the location of where people are. Indeed, the density of people in downtown areas was being driven in no small part by not just the movement back of millennials who didn't see suburban areas as a great place, but of baby boomers. Are boomers going to be moving into density areas again now? Are they going to want to have to be in a high density location? Or are they going to go back to living into a lesser density location? That's going to change things. We have the issue of transportation. What happens to them if you have a change in the location of businesses? Mass transit becomes a different kind of form. If you have people working remotely, David talks about the New Jersey Turnpike. One of the things about, for example, the Pennsylvania Turnpike is that it's a very, very heavy commuter location. It's a place where commuters use heavily, and that's true to some extent. Not quite the same thing in the New Jersey Turnpike, but in the Pennsylvania Turnpike, it is that in the Philadelphia area, it's just another highway. What happens if we're more remote? What happens if we change the locations? This affects the usage of highways, the demand for automobiles. It affects a whole pile of things. We talked about healthcare. We've talked about restaurants. And the last thing is the whole idea of how you structure development itself. This completely changes the idea of where do we have development? What are the kinds of developments that's going to be out there? Who is going to do that by who, which industries we're going to be looking at. And it's all structured on the idea of microeconomies. What's going to be David's point, the survivors, but it's not just the survivors, but where are they going to be and where are they going to locate? And why are they going to be a survivor and why can they continue to grow? And that's really an issue we have. So we have some winners and losers we know about. We know that their, remote working is going to move. Keep in mind, if you go back to 9/11, it changed things dramatically in the location of businesses and the support services. This is going to have similar kinds of impacts. It may take time to see it, but if all of those companies that were in downtown Manhattan that moved into central New Jersey, all those usage of technology where they had to separate and relocate their data sources, all the things that we saw that resulted from 9/11, we're going to see similar kinds of actions. They may not be the exact same industries, but we're going to see similar actions that are taken that are going to be extremely long lasting. And the last thing, and this is very important as far as New Jersey is concerned, and David touched on it, as long as we have a government policy that believes that trade wars are really good and getting into trade wars with the second largest economy in the world, and then trying to that is China, and then trying to put huge pressures on the third largest economy, or what maybe even as large as the U.S., which is the European Union. When you're into the middle of trade wars, you have some really, significant issues for New Jersey itself, because we are really one of the more important trading states in this country. The ports, the airports, the rail, the highways move goods in and out of the country. And to the extent that that's being hurt, that affects the trade segment of the New Jersey economy. And that affects South Jersey fairly dramatically because we are a transshipment point for goods going to and from the rest of the world. So we have tremendous implications that has, and this is going to change things dramatically. And you've got to look at, excuse me, not just the macro effects, but how it affects all of the industries, all of the sectors, all of the local businesses that are going to change as a result of that. So looking forward, we have all of these issues, the business location and the household locations. And then I want to talk about one thing very, very quickly. I think I have about 2.5 minutes to go on my timer here. And that's the fact that we have right now, and David alluded to it, the largest welfare system in the history of this country. The bond market is being supported by trillions of dollars through the Fed. The equity market is being supported by low interest rates, which is into the bond market, but also the Fed is now buying ETFs, and they are directly interfering. I call it interfering because I think it's wrong, in the equity markets as well. We have trillions of dollars, as David pointed out, coming from the Federal Reserve that support the bond and the equity markets. On the government side, if you take a look at the income numbers that come up, what troubles me the most is that while reopening is adding to wage and salary income, the income growth and the income is being for households being supported by all of the welfare programs that are out there as far as the government is concerned. Well, do we need them? The answer is yes, because otherwise things would be a lot worse. But we have a massive welfare propping up households in terms of incomes, directly through the unemployment insurance and indirectly through the PPP. Remember, people who are hired on the PPP are not being paid for by business income, they're being paid for by governments. And the last thing is the business, in terms of all the other government supports that are out there. And so what we have is the government is putting trillions of dollars into households' pockets, trillions of dollars into business pockets, and we have a massive welfare system. What worries me in the short to midterm is not just the changing in the structure of locations of business and households, but what happens as the government has to get out of being the primary economic driver of the economy. Keep in mind, we're going to have a federal budget deficit somewhere between $3.5 and $4 trillion without additional support. Given that we're likely to have additional support, it'll be between $4 and maybe $4.25 trillion, with another 2 to 2.5 in the next fiscal year. How do we have to get out of that at some point. When we withdraw that, that really worries me, because then businesses have to stand on their own, and I've got real worries about that. So basically what I'm saying is the recentralization and relocation is an issue for businesses, households in the short term, the government in the short term and the midterm, and also where all these changes shake out as we look down to the future. So that's my outlook. Keep that in mind in terms of microeconomies, and let's open it to questions.
Great. Thank you for that, Joel. And I think it's fair to say that, none of us have a crystal ball. But like always, you've given us the key themes to think about. And I think, as we sit here today, it just remains, it's all about the virus. And I think that your point about the micro look at the economy and all the businesses that support the typical industries, the re-centralization of how that looks like as we move forward. And that's very, very good business insight and advice. Jane, to be sensitive to our audience, I'm going to turn right to you to see if there's a question that we have time for, so that we can.
Sure. Yeah, we did have a question. We had a question that came in just prior to the start. The question is, there's a discussion on Capitol Hill about stimulus 4, Senator Menendez's bill. It's called the SMART bill, which would provide $500 billion in funding for state and local governments. Is it necessary, and is $500 billion the right amount? Thoughts, Joel, on that?
I'll be quick, because I know we're getting to 10:30, and we said we're trying to be off by 10:30. But the quick answer is absolutely, and it's probably not enough. I mean, just take a look at the shortfalls in terms of the local states. We're talking about New Jersey and Pennsylvania having shortfalls in the billions of dollars in tax revenues. It's going to take a couple of years before, at least estimates up to 5 years before we can get back to revenue levels. If you believe David's number of even in 2 to 3 years still being 10% below where we were, think about in terms of the revenue shortfalls. So you absolutely need it. I think what we need is a minimum of $500 billion, but that's probably just going to get us through this rest of this year, and maybe the fiscal year that tends to end for governments next June. But it's not going to really do a whole lot, just looking at the number. So that's a minimum, and we absolutely need it. Are there any other questions? Or I know we're headed to 10:30, so.
We'll turn it to you, Jean.
No, that was the last question we had. Thank you to David Kotok and to Joel Naroff for sharing their expertise this morning on the shape of the economic recovery and some implications on economic growth. Thank you again to our title sponsor, M&T Bank, and to Denise Monahan for her partnership in presenting today's webinar. And a special thank you note to Tim Grimm and his team at PCH Technologies for providing the Cisco WebEx platform we used this morning. There'll be an email to follow with the links to the recording of today's program. For more information about the SNJDC and our Economic Development Committee, it's available on our website at snjdc.org. The Economic Development Committee is co-chaired by Sam Donaldson at AECOM and Bill Whalen at Ocean First Bank. And the committee is currently organizing a seminar in August on offshore wind supply chain development in South Jersey. It's a follow-up to the seminar that we held last December, and details on that will be announced soon. This concludes our webinar this morning. Thank you for joining us. We wish you good health, a speedy economic recovery. Stay well and have a great day. Thank you for joining us this morning.
Thank you, everyone.
Take care.
Bye, guys.